Are we headed for a recession? Are we in a recession?
Most CEOs I talk to would say we are probably in a recession right now.
Right now.
You guys just heard it there. Larry Fink is saying that we are already in a recession and more pain is to come here. He makes a lot of interesting comments on inflation as well, and also the projections for Fed rate cuts going into the end of this year. Now, in this video, we're going to be covering what Larry Fink says, but quite honestly, if you guys have been paying attention to anything that we've been talking about on this channel before, if you really have like a solid understanding of economics and macroeconomics, Larry Fink actually may not be correct in his assumption right now, and we're going to cover exactly why, in that there is a potential and a route for quantitative easing to come back into this market a little bit sooner than what some people expect. Now, again, I've been talking about this a lot, even though that this is a potential and something that could happen kind of by the end of this year. What I would say is that there is most likely going to be more short-term pain in this market. And again, we're going to cover that in this video here too. And too many people right now are thinking that the 2025 market is the 2020 COVID drop. And they're rushing into this market and they're thinking, oh my God, I'm going to be late. There's going to be a V-shaped recovery back to these highs and the market's going to absolutely explode. Guys, something that I've been talking about with the Less Trades, More Profits community and the VIX Insights community is that it is so much better in this market environment to be late than it is to be wrong. With all this volatility that we have right now, I hope that you guys are out there, those of you guys that aren't in the community, keeping yourself safe, making sure that you are really taking your time and having that patience in this market to make sure that you're understanding the big picture, because that's what's going to drive price action. Has anything really changed with the big picture here and the potential adverse economic effects of this new administration at the start? No, and we have to make sure that we keep that in mind. So, before we get into all of the information that we have to talk about in this video here, if you guys do enjoy the information and analysis that I provide for you guys in these videos, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed. And for all of you day traders out there, one of the big problems that day traders have is being significantly undercapitalized. Again, that's where those prop firms come in. And Take Profit Trader right now, guys, is running one of the best sales that I have ever seen in the prop trading space. 30% off for life with code VIX with the link down below. No consistency rules and no activation fee, and they also offer daily payouts. So if you guys are interested in that, make sure you guys check out that link down below. But when we move over here and start talking a little bit about these comments from Larry Fink, again, what we just covered, most CEOs I talked to would say we are probably in a recession right now. Fink said at an event for the Economic Club of New York, and this is reflected in this evolution of Atlanta Fed GDP Now, real GDP estimates for the first quarter of 2025. We've talked about this a lot, that these GDP estimates have fallen off a cliff. They've recently rebounded a little bit, and the latest estimate as of April 3rd, 2025, is that we're going to be witnessing a negative 2.8% GDP growth rate in the first quarter of 2025. One CEO specifically said, the airline industry is a proverbial bird in a coal mine, canary in the coal mine, and I was told that the canary is sick already. The asset management executive also said that he thinks the tariff policies of President Donald Trump could put upward pressure on inflation and make it difficult for the Federal Reserve to cut interest rates, as the central bank often does during recessions. Now, the thing that I think a lot of people are missing about these tariffs is that, and Powell is actually probably going to be right about this, that if we do see any of these inflationary effects of tariffs, they're probably really going to be one-time price increases, and it's not going to lead to higher rates of inflation moving forward, but rather a one-time price increase across the board on a lot of these goods and services. But what I do want to bring up here as well, and something that we've talked about a lot in other videos, is the fact that if you see a lot of these price increases across the board, what this is going to do is it's going to decrease aggregate demand. What that is going to end up doing is decrease prices. Lower demand with the same amount of supply, prices are going to go down in order to meet that demand. And then when you combine that with things like looking at the price of oil, again, oil is in so many of the different aspects and sectors of CPI. Again, oil has been falling through the floor here. So when you look at all of this data in total, there is a route for this type of balancing act in a lot of the different elements of CPI, and we may not actually see that aggressive move to the upside in the actual rate of inflation that a lot of people are expecting. Now, what I've talked about a lot of times in the past as well is that you can look at the bond market in order to get a good understanding of, okay, are the big players in the bond market pricing in inflation? And the way to kind of read that is that if bond yields are moving up, it means that our investors are foregoing the opportunity to buy bonds now or are actually selling bonds in the present because they think rates are going to be higher in the future. Because if you're going to see higher rates of inflation, the purchasing power and the value of the dollar will decrease, and you are going to need a higher nominal return on these fixed income securities in order to get the same real return, which is going to account for inflation. So when we come over here and take a look at the 10-year Treasury yield, what are we seeing? Well, we are seeing a drastic move up in bond yields off of these lows here. And remember, the Trump administration, one of their main goals right now is to be able to refinance a lot of the debt that is rolling over this year at lower interest rates. So this is not what they want to see at all. But what you have to understand here is that context matters, and it matters a lot. Could we see a little bit of some of these inflationary pressures in the market, or really price increases, one-time price increases across the board? We could, but we haven't seen any signs of that yet. I don't think it's necessarily time to be overly worried about inflation until it actually happens and shows up in the data. Now, this week's CPI report coming out on Thursday is going to be for March. So with those Mexico and Canada tariffs and a little bit of those China tariffs, you might see that starting effect of some of these tariffs here, but you're really going to have to wait for that next CPI report after these new tariffs go into effect in order to really get a better picture of if inflation is actually going to be moving back to the upside. But right now, at face value, by looking at the bond market, you would think to yourself, oh, this market is very, very worried about inflation roaring back to the upside. But when we take a deeper look into this situation, there is something else happening, really two other things happening that all of you guys need to understand. The first is when we take a look over here and look at the probabilities for what the market is expecting for rate cuts going into the end of this year. Well, just last week, there was a 19% probability of a May rate cut. That projection now is all the way up at 48%. If the market as a whole is expecting a 50-50 coin flip toss for if there's going to be a rate cut in May, it obviously is going to show us that they are not as worried about the inflationary effects of these tariffs as the media would really want all of us to believe. Now, the second thing that's happening here, which is very important, has to do with foreign governments here. Now, which countries own the most U.S. debt? Well, about in total, if you look at the total numbers, as of April 2024, again, these numbers change, but not by all that much. Foreign countries own approximately $7.9 trillion in treasury securities, or 22.9% of U.S. total debt. So about 22 to 25%, it's going to fluctuate a little bit every single year, of the total outstanding amount of U.S. debt. Now, who owns the rest of it? Well, a lot of that is going to be the U.S. Federal Reserve and also domestic organizations here. Now, when you think about the current situation that we are witnessing with global trade and the potential for the, let's say, instability or uncertainty about where the U.S. economy is going to be going in the near future, well, it's not going to make a whole lot of sense, or a lot of these other foreign countries are not going to want to hold on to or continue buying U.S. bonds if you're effectively going to wage a trade war on them. Now, what I want you guys to think about here is the broad picture, the big situation of what we're dealing with in this current market. We have unemployment going up. We have growth expectations slowing down. We have CEOs already saying that we are in a recession. We have foreign governments potentially dumping U.S. Treasury securities, and we don't know if inflation is going to come roaring back to the upside yet. Remember, we have to wait and see if that's actually going to happen in order for us to make decisions moving forward. So, I want you guys to think about if the bond market goes no bid, effectively, where people are selling bonds at crazy amounts here, which they are, who is that buyer that steps up? Well, it's the Federal Reserve. Now, how do they do that? They do it by printing money through quantitative easing. Now again, thinking back to what I just said, slowing growth, higher unemployment, if inflation doesn't come roaring back to the upside, this is a very realistic possibility and a probability that this could happen at some point later on in this year. And it really feeds into that thesis that we've been talking about on this channel here, really just in terms of the probabilities of what could actually occur in this market, that the Fed is going to end up being behind the curve. Growth could end up slowing down significantly, not only just due to these tariffs, but also due to the austerity measures that this new government and administration is taking underway. And that could really slow down growth, increase unemployment. If you don't see those inflationary pressures come back into the market, you could easily see more rate cuts than what the Fed is currently expecting. And then also the potential for quantitative easing to come back if a lot of these governments abroad are going to continue selling off U.S. Treasuries. Now, there's another thing that we have to talk about here that could, I don't want to say throw a wrench in this whole situation, but remember, there are a lot of negotiations happening right now between the Trump administration, really specifically right now, Japan, South Korea, China, the EU, a lot of these other really major players that these tariffs are being levied against. Now, if part of those negotiations does entail these different governments coming in and buying U.S. Treasuries, well, that creates a little bit of a different situation here, because if bond yields don't continuously start skyrocketing, there isn't necessarily that need for that quantitative easing and the Fed to step up, and we could just end up seeing that situation where we see more rate cuts than what the market is currently expecting. And I would kind of label that as kind of the base case here, because again, just logically speaking, if you understand macroeconomics and economics as a whole, if you see that significant decrease in aggregate demand, you are already seeing a lot of these commodity prices moving to the downside here. We also have a lot of potential negotiations that could come into play. These new inflation fears could easily be way, way, way overblown. And the last thing that I want to make clear to everybody is this does not mean that in the near future we're going to have this crazy V-shaped recovery and you need to rush in and buy stocks. No. Think about where we're headed over the next couple of weeks here. Remember, we already have Larry Fink saying that CEOs are already saying that we're in a recession. We have big bank earnings coming up this Friday. Earnings season is starting up. It is very possible that these companies can beat their numbers for Q1, but their guidance and really what they expect to happen throughout the rest of the year is going to be, one, a lot more uncertain, and two, they could easily lower those earnings expectations going forward into the rest of this year. So again, this is a situation that is going to take a little bit of time to play out here, guys. But again, for those of you guys that are watching this channel, learning and understanding these things, which is my goal for you guys here, again, hopefully this is starting to make sense. A lot of the times in the market, guys, I've said this a lot to the members of the private community in the past, if you want to have different results than everybody else, you have to think and act differently like everybody else in order to have different results than them. Again, if you just think about, let's just say, day traders, the vast majority of them fail. So if you're going to continue to do the same things that they're doing, well, you're just kind of accepting that you're going to have the results that they are going to have. When you think about this in the form of kind of the broad market here, a lot of the times if you can build these really solid contrarian views based on data and really look at it from a probability perspective and be ready for when those probabilities start to get even more and more likely, well, that is where the real money is going to be made over the long term, and is probably going to be when we start to see this shift happen, the sign of the actual bottom. So that is going to wrap up this video here, guys. If you guys did enjoy the information and analysis I provided for you guys in this video here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you want to see more videos like this, make sure that you guys are subscribed, turn on notifications so you're notified every single time these videos do end up going live. But until next time, guys, I will see you. Peace.